Well, good evening, everyone. Welcome to ODI. Welcome to this meeting on achieving financial stability and growth in Africa. The meeting is organized by the DFID ESG Growth Research Program, which is a program that funds high-quality research on growth issues in low-income countries. And the program involves around 40 grants and around 200 researchers working on a number of themes, including finance. And today you will hear the outcome of one of the projects led by Professor Stephanie Griffith-Jones to my right. Let me just briefly say and remind ourselves why it is such an important topic today. It is, of course, important to achieve inclusive growth. Inclusive growth is very important for poverty reduction in African countries. So that's critical. I don't think we need much more reminding on that. But what is also important is that African countries want to achieve financial stability. Financial stability can undermine growth and development achievement. So that is quite important to achieve financial stability. And it's not easy to achieve financial stability. Adair Turner was here not so long ago, and he reminded us that it's almost an inevitability that there are financial crises that are fueled by real estate booms and busts. And there is also no guarantee that finance is going to the right sectors that are important for inclusive growth. In fact, there's almost a guarantee that most of the finance isn't going to the areas where it's highly needed. I mean, he mentioned that about 14% of credit is going to non-real estate sectors, and I think that's just a reminder of the challenges that we face in developed countries. But it's also a challenge for developing countries, and in particular African countries at the moment. We all know that African countries have now piled up quite a lot of debt, sovereign debt, for example, in the last few years, and that may lead to some financial challenges in the future. But there is also a range of economic crises facing African countries. So think about the China slowdown that we've heard about. There's now a couple of years of low commodity prices, in particular low oil prices, and we will now also have Brexit on top of that. And that can bring quite a lot of challenges to African countries. And work by my colleague Judith, who sits there, it might be suggesting that we're actually going to face quite a tough period in terms of financial market development in the future. So we do need to think about financial stability as well. So a key question for today and for today's meeting is how can the financial sector be regulated and developed in such a way that it can still channel the finance to the real sectors, to the real economy sectors, and can be inclusive, can lead to inclusive growth, while avoiding booms and bust cycles. And to discuss that, we've got a really excellent panel, and we'll discuss it on the basis of a book that's been edited by Ricardo Kotschalk and Stephanie Griffith-Jones. I think Ricardo also sits here, and Stephanie Griffith-Jones, who was a principal investigator of a DFID ESG Growth Research Program. And she is also a research associate at ODI and at IDS, and also works with Professor Joseph Stiglitz. So she's an authority on financial market development. And we're very fortunate that there will be two commentators on her presentation. One will be by Odo Ayakai, who is chairman of the African Center for Shared Development Capacity Building, but many of you may also know him from his capacity of leading the research at the African Economic Research Consortium. And he's come over from Nigeria also to talk about the Nigeria case, and he's got a chapter in the book, but also more widely about some of the challenges that are facing African countries. And then finally, we will have a comment from Victor Morinda, professor at Birmingham, professor of development finance, and he's also a grant holder in the DFID ESG Growth Research Program, which is just starting up, and it's a 3-year or 4-year program involving a very wide network of researchers on financial inclusion, inclusive finance. So they're all very well qualified to discuss the topic. Let me also welcome the online audience, and you can tweet There is a hashtag Africa Growth, and there's the DDRP Growth Twitter handle. So do join in. You can also send questions, and it will appear on my iPad here. So without much further ado, I'll just like to hand over to Stephanie, who'll talk for about 15 to 20 minutes on the findings, and then I'll hand over to Olu and Victor, and then I will open up the floor for discussions. Over to you, Stephanie.
Well, thank you very much. As always, delighted to be here at ODI and with such a fantastic panel. The chair and our two colleagues who are going to be such distinguished commentators, and such a nice and mainly very young audience, which is always encouraging. Actually, as you get older, you find everybody else very young, so that's partly a bias. So I want to start with this challenge that Dirk raised so well about the needs that we have for a financial sector that at one level helps finance the real economy, or we could say in development terms, helps finance inclusive and sustainable growth. And also now, if we're thinking particularly in poor countries, but also even in Europe, we're thinking about the need to fund structural change, structural transformation. And thirdly, that it does no harm to the rest of the economy. I always like to compare when doctors, when they swear their Hippocratic oath, they are asked to swear an oath that they should not harm their patients. And in the same way, we should request the financial sector not to harm the rest of the economy. And this is, of course, not an academic concern, because we have seen very costly financial crises throughout the emerging economies, more recently, unfortunately, also in Europe and, of course, in the United States. Luckily, in Africa, we haven't seen financial crisis more recently, and this is a good thing, but it's not a case for complacency, because these crises are extremely costly, and in very poor countries, they could be even more damaging to very poor people. So the first issue that we looked at was the size of the financial sector, and there have been like two kinds of schools on this. The first one is saying the bigger the better. So the more you develop your financial sector, the more it grows, the deeper it is, you will have more growth and development, and it's good for everybody. And there was a lot of empirical work. People like Levine were arguing that. But early on, already Easterly Islam and Stiglitz, and Joe Stiglitz, as Dirk said, is my boss, so you always have to quote your boss, pointed already in 2000, based on empirical data, that if you go beyond the level of about 80 to 100% of credit to GDP, it may actually have a negative impact on growth, and particularly increase volatility of growth. And after the global financial crisis, there has been a number of papers which have emerged in the IMF, in the Bank for International Settlements, saying that you can have too much of a good thing, that too big a financial sector can actually damage growth. And also, what has emerged very clearly is that the pace of growth of the financial sector is very important. So that if you have a very rapid expansion of credit, this may inevitably contribute to likely crises. And this is fortunately not happened so much in, as I said, sub-Saharan Africa up to now. But the only one of the few countries where there was very rapid credit growth, which was Nigeria, actually did have a financial crisis, and we will benefit from hearing more from Olu about that. But even this crisis, which was a sort of middle-range crisis, not one of the worst, led to a cost of bailing out the banks, a fiscal cost of about 8% of GDP, which is quite a lot of money. There is the second problem, is where the loans are going. And people like Thorsten Beck have argued that if the credit goes to enterprises rather than to households, it will have a bigger effect on economic growth. But we know that in the advanced countries, in research that Dirk mentioned, that Adair Turner quoted in his book from Bank of England data, in the UK only 14% of credit goes to enterprises. 14%. The rest either goes to other banks or it goes to real estate. And so that is a structure of lending which we don't particularly want to encourage. Now, are all these discussions about middle-income countries and emerging economies and developed countries relevant to low-income countries? Because African low-income countries in particular have a very small level of financial development. They're way below this range of 80 to 100% of credit to GDP that Easterly Islam and Stiglitz said were the dangerous level. And they're way below what also the IMF and the BIS is saying. You know, people are worried about China because China has 250% credit to GDP, a level almost as high as the US, or similarly high as the US had before the big subprime crisis. And these African countries are on average around 20% of GDP credit. So is this debate relevant? So I would say that it's relevant in terms of the issues about rapid growth of credit and the dangers that arise from that. Secondly, it's relevant in terms of the structure of credit. How much is long-term? How much is short-term? Does it go to the right sectors? Does it fund productive development? Are the loans long-term enough to reach that? And I think that there are problems in all those areas. And is the credit affordable? So there is a problem about, so many people say, oh, the key challenge in low-income countries is we have to increase very rapidly the size of the financial sector because it's too small. Only 20% of GDP, the credit, and it doesn't provide enough finance, which is true, to small and medium enterprises. But the key is how you do this and how you avoid financial fragility to avoid crisis. And of course, when we were writing this book, Africa was doing very well. It was growing about 5%. Commodity prices were very high. Capital flows were booming. This were called the new frontier markets. But the story has changed. And as for example, Judith has been writing, capital flows are reversing, and their cost is significantly increasing. So the vulnerabilities that have been created in the past are greater. So it is still very important to avoid a financial crisis. But there are also positives. I think the fact that the financial sector in the low-income countries are so small gives the advantage to the policymakers that they can try and shape the financial sector so that it serves better the needs of long-term development. So they don't have to repeat all the mistakes that we have made in the developing countries, in Latin America and Asia, and indeed in Europe and in the United States. They can learn from our mistakes, learn to avoid financial crisis, learn to avoid much of the money going into unproductive investment, real estate, and so on, and learn to channel it towards the more productive part of the economy. So I think when I speak to senior policymakers in low-income countries, they always complain, oh, we have such a small financial sector. I say, yes, but you have the opportunity to leapfrog and create a good one. And also, in political terms, if the financial sector is not too big and you don't have very powerful banks, you have more freedom, for example, to regulate it better. I mean, they have, of course, in Africa, large foreign banks which are internationally active, which may perhaps try and influence them, and they have some large local banks. But the fact that the size of the financial sector isn't so good can help avoid what is called regulatory capture, which is when the regulators are doing not what is best for the economy or for long-term financial stability, but what is best for the banks themselves. So what are some of the findings of the project? One of them was that although access to credit is important, and of course small and medium enterprises, in particular in the small, poor African countries, have very little access to credit. Small companies, for example, have only 17% of them have any access to bank credit. The quality of the lending is also very important. And this means maturity. That is, there is a great dearth of long-term lending, which you need to finance investment, but also the cost. And it's very interesting that also, including by World Bank data, the spreads between what the banks pay the depositors and what they charge the borrowers is much higher in low-income countries, about 15%, than it is in middle-income countries, where it's about half, and what it is in high-income countries, where it's about less than a third. So it's 15%, 7.5%, and 4.4%. And we try to understand why this happened. The standard reply is lack of competition. But in fact, we found that bank concentration was not worse in the poor countries than it is in the high-income countries. And secondly, that in countries like Ghana, which was one of our case studies, the number of banks has doubled in the last 2 decades, and yet the spreads have not come down. So there is something else happening, and there are 1 or 2 exceptions, like Tanzania, where spreads have come down, and there have been also a number of institutional improvements. For example, the creation of, even with support from DFID and others, of credit bureaus, which improve the information and therefore reduce information asymmetries in the giving of credit, which, in spite of all that, the spreads have not come down. And so we have some slightly radical proposal that maybe central banks and governments should look at the possibility of capping these spreads to facilitate a lower cost of intermediation, so that the borrowing costs by SMEs and other borrowers can be lowered, and the returns that savers get can be increased. And the reason why we think this would be feasible is that a lot of the banks in low-income countries are very profitable, and in fact increasingly profitable. For example, when we looked at Kenya, the profits of banks was $70 million in 2002, and it had increased recently to 1.2 trillion. So it was increasing at almost 40% a year. So the banks could afford to have lower profit margins. So it's good that the banks are profitable, but it's not good that they're so profitable that they charge so much for the services. On the issue of maturity, this is a very important issue. And we had in our case study of Ethiopia is an interesting experience because they have dominantly public banks. They don't have any foreign banks. In some ways, it's a rather extreme case. And they have a very large public development bank, which is funded in a rather peculiar way by taxing private banks. Maybe that's not a good idea. But it has a strategy of using long-term funds to finance long-term investment for structural transformation. And it has funded a number of key sectors like infrastructure, like developing new sectors like the export of cut flowers, residential housing, and so on for poorer people. And so I think this is a well-run development bank, good development bank, which is efficient, with good governance, can provide a valuable complement to the private banks. And it would seem that, as in other regions, the kind of German style of model, or the Dutch style of model, where you have a variety of financial institutions, where you have a diversified financial system, where you have large banks and small ones, you have public and private ones, you have national and foreign, you have cooperative banks, different categories of banks, as well as the big international banks, can work better because you diversify the risks not just within the banks individually, but also across the institutions, and you can serve better different categories of clients. Obviously, a big international bank will be better at servicing the needs of a big multinational, but in the same way, a small cooperative bank in a region may be better at serving small SMEs because it's closer to them. So I think this issue of diversity is something that we found could be quite valuable. We also looked carefully at the issues of regulation, and Ricardo Gocek, who's over there far at the right, wrote a very nice chapter on that. And we thought about it in the following way, because after the global financial crisis, there has been a very large debate and introduction of very complex regulation. And even people in developed countries, leading people like Andy Haldane at the Bank of England, have said that regulation has become too complex, even for countries with such complicated and deep financial systems like the UK. But this is even more true for the far simpler financial systems, far smaller in developing countries. And as we discussed today, the poor countries, the low-income countries, are not represented in the standard-setting committees like Basel Committee and Financial Stability Board. So these standards are developed more for the Brazils of this world and the United States of this world, rather than for the Ghanas of this world. So to evaluate regulation, it needs to be done in ways that reflect the characteristics of these poor countries. And for example, this raises issues like, for example, currency mismatches. So a lot of banks will borrow in foreign currency and lend in local currency, and that creates specific kinds of risk. Or they will lend to a particular company in dollars, and this company then produces goods that it sells on the domestic market. So we need to look at these specific risks that are relevant to developing countries and that are not so much focus of these international bank regulations. And people like Victor Murinde and others have done very valuable work. And particularly, we need to link the risks with the macroeconomic risks that these countries face: commodity price shocks, reversals of capital flow. So before I finish, I would like just to say that we identified kind of areas for future research. And one of the areas that we didn't expect, but is this area of how to reduce the cost of lending, how to reduce the spreads of lending, which is a fight everywhere. I just by chance met the chair of the competition committee in the UK, Alistair Smith, and he was raising similar issues of competition and cost for UK banking, of course at another level. Secondly, I think the issue of the structure of the financial sector to maximize development impact and to minimize the risks of financial stability is an open area of research. And I think the issue of managing capital flows is unfortunately again coming to the fore as capital flows dry up to the low-income countries. And this is particularly a problem, I think, in the case of these countries for government borrowing, because African governments were a little bit too seduced, I think, by the ease with which they could raise money on private capital markets at relatively low costs. But as their currencies depreciate, and as the cost of that new renewal of those bonds, which are fairly short term, increases quite significantly, then it becomes highly problematic. In other areas of the developing world, the main issues, for example, in China or Latin America, is more about corporate debt, private corporate debt, and therefore issues of managing capital flows, possible previously capital controls, not now because there's not enough money coming in, are important. But in the case of low-income countries, that is also the case, but it's mainly about how you finance government debt. And the final issue, which I think has been maybe understudied in these African low-income countries, is the whole issue of how you do macroprudential regulation. And maybe I could finish with that. The idea of macroprudential counter-cyclical financial regulation is basically that you lean against the wind. A former governor of the central bank of the Fed of the United States said it's how you take away the punch bowl when the party is at its best. Yeah? Because when things are going well, when commodity prices are high, there's a lot of capital inflows, a lot of growth, everybody's very happy and people tend to lend a lot. And it is the role of regulators to spoil the party a little bit and say maybe these good times will change, and therefore you have to make reserves, you have to make provisions, you have to make have higher capital adequacy requirements, so that when times turn bad, the banks will be stronger and will be able to continue lending, which is the most important thing. And this is now recognized internationally. And I think maybe it's not implemented so much or not discussed as much as perhaps it should be in these low-income countries, because they have other regulatory measures. But I think to think in this macroprudential regulatory framework is valuable. So I'm delighted to be able to present these results. We found in the research some answers, but even more questions. And so I'm also delighted to be able to participate in this new phase that Victor will be leading.
Well, thank you very much indeed, Stephanie. That's been really good. Let's have applause. So thank you for laying it all out so very clearly in terms of the links between financial sector development and inclusive growth and stability. Some issues that we do need to think about. It's about how to scale up access to finance in the right way. We need to think about the cost of credit, and with the radical proposal to cap the interest rate spread, for example. But also thinking about a more diversified financial sector that can better serve the needs of the real economy, and also issues about the appropriateness of standards, global standards for low-income countries, and finally thinking about countercyclicality of the financial sector. So lots of issues to get stuck in. I'd now like to hand over to Olu for your comments, and particularly from a Nigerian perspective. I think to hear from you how Nigeria is going to face the challenges at the moment, and how it's been doing over the last decade or two.
Thank you very much, Jack. Good evening, ladies and gentlemen. It has been a privilege to be part of this, very wonderful team led by Stephanie and team, for providing the guidance, leadership, which resulted in this very wonderful book, which I'm sure many people will find very useful. Now, I just want to throw a little bit more light on the Nigerian situation and possibly draw, some lessons from what we have done. In the Nigerian context, and as in the chapter on Nigeria in the book, the concern of the monetary authorities from time immemorial has been to ensure that Nigerian banks do proper intermediation, like Derek was talking about. So all reforms, regulations, moral suasions, even bank-inspired initiatives to show empathy with the need had always been in that direction. In the Nigerian context, we had an era of massive liberalization of banking industry, and that led to an incredible growth in number of banks, from very small numbers, less than 20, to 89 within a space of 7 to 10 years. Then the requirement for setting up the bank, a bank in Nigeria was so small, that almost anybody could, get license and open up a bank. Now, luckily, before the crisis came, we had a very, excellent macroeconomist as governor of the bank, who was just appointed by, President Obasanjo, and he got there, possibly from his own, period of engagement at the academic level. He properly recognized that these small banks may not be able to do what the industry should do for Nigeria, and he therefore embarked on what he called bank consolidation. The result was then that the number of banks declined through mergers, acquisition, not necessarily, complete, collapse of banks, but through mergers and acquisition, having raised the capital requirement from 2 billion naira to 25, within a short space of time when everybody must comply. So the encouragement was that, look, if you are too small and you cannot raise the additional capital to meet this requirement, please merge. And many of the mergers took place, many acquisitions took place. Result that we then came down with 25 banks, by the end of 2005. And of course, one of them ran into trouble, so we ended up with 24, and that stayed on for a long time until very recently. And when the crisis then came, it made a very robust bank that can, banking system that can absorb the shocks. But that does not still eliminate the need for Nigerian government to then bail out. The reason is we then have banks that then became too big to fail. They became too like, if there were small banks like we had in 1991, 92, where banks collapsed and they were just waved off, and let anybody who has deposit beyond 50,000 naira to go to Nigerian Deposit Insurance Corporation and get 50,000. If your money is more than 50,000, then it's your fault, not monitoring the development around your bank, and therefore protect yourself by either moving your money out before it collapses or not that. So the NDIC was to protect small depositors. It was not to create moral hazard question where people start putting money in the banks and go to bed. So in any case, that was what happened. But when the crisis came in 2008, 2009, then the issue of too big to fail came, and government then had to step in. Luckily, we had fiscal space at that time because the price of oil, and the prudent management of the immediate past government, where they had significant, savings, particularly in the context of, saving the excess of our crude oil earnings, which was higher than the benchmark price for the budget, and the government was very frugal to actually make sure the savings were there. So the government had, also the fiscal space. So too big to fail, along with fiscal space, government was able to bail out banks. And what they then did was set up what we call bad bank, which is called Asset Management Corporation of Nigeria, AMCON. So the 8% of GDP that we spent on that was therefore affordable at that time. So we were very lucky that we had that kind of arrangement in place. Of course, when Soludo left and Sanusi came on board during the crisis, he moved on that front and he succeeded. So the question now is, what can we do going forward now that we are in an era of another maybe exogenous shock, but not from the financial system, but from the real sector, where the price of oil is now going down, and therefore the fiscal space of government is not there. At the same time, the banks had exposed themselves to the so-called very attractive sector, which was oil. Before, they were busy only in buying and redeeming government treasury bills, partly with government deposits with them. But what has happened now is that government deposits has been taken back to the central bank. The oil market is not performing, so you see another kind of incipient emergence of crisis in the industry through, gradually rising non-performing loans and, persistent governance challenges, where a lot of insider dealings, are happening in the industry. We focus more on the banking industry in Nigeria because the Nigerian financial system is dominated by the banking industry. So that's why we therefore, focus almost, exclusively on the banking industry. So the challenge going forward, therefore, is what can we do if by any chance the declining price of oil continues to remain at this perilous state? Fiscal space of government is not there. So these are challenges that are coming up after the book had been finalized. The initial thoughts that we, the team that worked on the Nigerian chapter, is having is maybe the lesson of the bad bank, which was feasible by the fact that government had fiscal space, can be learned and adapted to the emerging environment of no fiscal space, and yet challenges are coming. And that's why we are thinking going forward, maybe not for these immediate challenges, but going forward, even if the price of oil bounces back, maybe in addition to banks being encouraged to take insurance cover for small depositors, they may also be encouraged to actually go into buy insurance for their portfolio. In essence, internalize the bad bank framework so that you insulate the fiscal authority from having to come to bailout. So if you are getting exposed to certain sectors, you may be encouraged to please put some money away just in case. And of course, if nothing happens, you get returns because the money will not be sitting idle. It will also be invested. Secondly, and an important point that Stephanie made, the banks basically are short timers. The needs of the Nigerian real sector is a combination of short and long-term loans. Unfortunately, the capital market is not yet in a situation that can meet the needs of the SMEs because the listing conditions are not yet friendly enough to them. So what we then see in the Nigerian context emerging is that we are reviving the development banks. They were scrapped, closed down, during the heady days of immediate structural adjustment program era of 1986. But experience has shown that that gap has not been filled by the private sector. So the government is reviving many of the development banks. Bank of Industry is now back. Bank of Agriculture has now been consolidated, and so we're having these two banks, working now through commercial banks. And say, okay, we have this money, we give it to the commercial bank for on-lending, and then in that context, encourage the banks to now be giving, complementary short-term loans to make sure that the long-term loan that they are getting from the Bank of Industry, from Bank of Agriculture, actually performs. One lesson that we're also learning is that, and that is showing in various analysis of the challenges facing the Nigerian economy, is that finance is not the only problem. Finance is an important problem, but not the only problem. There are structural issues, which is infrastructure and governance, which government is now addressing. The 2016 budget is very heavy on infrastructure, and through the various attempts to clean up the governance system, you are finding corruption being dealt with. Hopefully, that will reflect in better governance going forward. So when that is successfully done, then we may find a situation whereby the Nigerian banks be more predisposed to lending to the real sector through this complementary, short-term, financing to support the long-term loan that they are themselves, on lending to the real sector. The issue of banks giving loans to the private sector agents and sitting back, waiting for them to fail so that they can go and sell their assets. Again, because of this combination of development bank and commercial bank operations, we are seeing that commercial banks working with the development banks are now seeing that there's need for some kind of hand-holding, of the SMEs. So it's not just enough to give them money. You must also be able to give them technical support through giving them information about markets, about technology, about keeping proper records, and helping them to actually succeed instead of waiting for them to fail and go and recover your asset. Finally, Nigeria is having an interesting experiment with what we call non-interest banking. These are all things that came out after our contribution to the chapter, to the book. And this non-interest banking, which other people call Islamic banking, is beginning to provide an interesting experience, because the non-interest banks are doing just as well as the interest, the regular, orthodox banks. But it is still to be investigated. What is the difference? Because they are lending to, quote unquote, real sector. But how do they select their real sector? Do they give them money and support? Like we are saying, that money is not enough. Money plus other assistance can then help, firms to succeed, because the non-interest banks have interest in the enterprises performing, making profits, because it's out of their profit that they get some money. So since they are waiting for the bottom line, they cannot just go and sit back. They look in very closely, and I think that is beginning to have some result. But then this is still very preliminary. We need maybe Judith can help us investigate that in the future to actually find out exactly why is it that the non-interest banking and the other banks are doing equally well, even though these non-interest banks are exposed to the real sector. And the lessons from there may then help government to decide what to do in terms of actually supporting expansion of these non-interest banks that are doing what society wants banks to do in general. So I think, again, it's a privilege working with Stephanie, and I will always remember the opportunity. Thank you very much.
Well, thanks, Olu. Thank you very much indeed. It's also so reminding us of the sort of the severe challenges that Nigeria is facing at the moment, but also thinking about some potential solutions. So thinking about a development bank or dealing with the bad bank issue, which of course raises other challenges to do with what actually makes a good development bank, and can we be sure that this time a development bank is actually working, whereas maybe in the past it might not have worked. But also issues about sort of Islamic finance, which are quite interesting to explore further. Over to you, Victor.
Thank you, Doug. It's a great pleasure. I should say it's a double pleasure for me to be here at ODI. First of all, the policy debates at ODI are always very inspiring to me. And secondly, it's a great opportunity for me to celebrate the launch of the influential book by Stephen Griffith-Jones and the company. I say an influential book in the sense that during the beginning of 2015, last year, I was going around enjoying the pleasure of the work that I submitted a case study in the Research Excellence Framework 2014 of UK universities, and this was a leading study on shaping bank regulation in Africa. And I was getting congratulations everywhere, more or less assuming I was a celebrity. And then I got Stephen's book. And then I read the book. I realized I knew nothing. So the book was very, very influential, talking about issues on bank regulation, which I had not covered in the case studies I'd been doing for more than 80 years. That culminated into that higher rated impact case study. And why? The book was very influential and really impressed me so much for one simple fact. We know that the traditional classical roles of central banks is financial stability. So that's addressed in the study. But we also know that in the last couple of years, central banks, especially in developing economies, and more specifically in Africa, have been pushed by the experience that 6 out of the 10 fastest growing countries in the world were in Africa, globally. But at the same time, that rapid growth was not being shared by the majority of the population. So there was a need of addressing this question of inclusive growth. And the central banks took up that agenda mandate very quickly. So central banks found themselves balancing the classical role of financial stability with the inclusive growth mandate. And they are not necessarily complementary, because in pursuing financial stability, you may hurt an intended consequence. You may hurt the agenda of inclusive growth. And so this book was very fundamental in trying to balance these roles. How do you regulate the financial system and structure the regulation in such a way that you can achieve the twin goals of financial stability, the classical role, and inclusive growth, the new agenda? And the book had very interesting case studies in Africa, so I found it very inspiring. But also very inspiring with the way this research was done, which was funded by under the DFID SRC Growth Research Program, was that in the first 4 chapters, as you can see in this particular book, the first 4 chapters just provide comprehensive surveys of issues, surveys that touch on our current knowledge. Okay, and they always say that, the little I know, I owe it to my ignorance. So you read this very extensive, very thorough survey in the 4 chapters. And then building on that, you go into very detailed, insightful research on a number of case studies. Kenya by Francis Mwega, again a leading researcher. Nigeria by Good Or here. Ethiopia by LM. And then there is also the study on Ghana. And then you find that basically it's also a mix of very fast reformers like Kenya with not so enthusiastic reformers as in the case of Ethiopia. But I also, in hindsight, saw that the book was timely in the sense that it comes at a time when the entire regulatory framework is being restructured. I'm talking about Basel III, with a lot of initiatives, with a lot of countries signing up on bank regulation, but not implementing bank regulation because the supervisory framework is weak. You have to be able to distinguish between bank regulation and bank supervision. Bank supervision do the hands-on experience of implementing the codes of regulation. But if they are not trained in the up-to-date Basel III tools, then they cannot be able to do the supervision of banks, even when the country has signed on to adopt Basel III. So the book was timely in that regard, coming up at the time when many countries are restructuring, they are trying to adopt a Basel III, and even dealing with some of the issues in Basel III, like the capital adequacy or the capital buffers, which is contagious in Basel III. Now, I think I came to an observation that the case studies on those countries, we ring bells with researchers who are working on similar issues, but also resonate with the policy advisors and policymakers at many central banks in Africa. There are many takeaways, and let me give an example here. One of the takeaways, which I think Stefan mentioned here, was that there is not enough finance to support inclusive growth. And I think the fact here, enough finance possibly is not in terms of the quantity, because research is progressing to show that maybe too much finance may inadvertently harm growth. We are talking about the quality of finance being offered. Okay. And the new emphasis on financial inclusion, the full definition of financial inclusion, has one on the quality of finance being offered. And especially the finance that will be required by the missing middle, by the medium and small enterprises to support entrepreneurship spirit on the continent. But also what is interesting is that we are looking at the various projects funded by the FID and the SRC in Core 1, and we find a type of similar to the Mackinnon-Shaw finding of 1973, in the sense that Ronald Mackinnon was working in one part of the globe, and Shaw was working on another part of the globe, and they came to the same conclusion on observing the trends in financial development, henceforth the Mackinnon-Shaw hypothesis. But here was something very interesting. Stephen Griffiths Jones and company, they looked at this regulation and aspect of particular banks in Africa. They noted that the banks were being characterized by high loan rates and high cost of capital, and that was impeding financial intermediation, which translated into finance and growth. The Metriadis and the company at the University of Leicester were also looking at many banks, including African banks. And they noted that among African banks, there were high default rates. Okay. And that was impeding financial intermediation. Now you see the link at the traditional models we use for credit, for pricing credit, for pricing bank loans. We basically have the cost of capital and then lambda, which is a markup, and the lambda is influenced by actually the default rates on previous loans. So if the bank suffered default of about 10%, it will add 0.1 to the cost of capital because we want to recover the previous lending. So basically the high default rates that Panicos and group identified is consistent with the high spreads and high cost of capital that Stefan observed. Independent researchers funded their own common enemy, they are funded by the same funders, but arrive at a conclusion. This has to be taken seriously. And the finding has implications, A, for regulators, for central banks. And I know from conversation with a number of central bank governors on Africa, they were specifically concerned about this question. I remember having a long discussion with the advisor, central bank governor of Rwanda, about how do we deal with this high cost of loans. Okay. It will also be interesting to practice bank managers in terms of how to deal with the high default loans. How do you cope with the high default loan on your books? Now, I've almost looked at commercial banks, not only in Africa, but globally. I did the World Investment Report way back in 2007. So it was all the commercial banks on the, as known as reported. Okay. And a particular issue which comes is that some banks may report high profitability. That's simply because they have not done provisioning. But you are sitting on a time bomb. You may ignore provisioning for 1 year, 2 years, 3 years, but the problem persists. You can't do it forever. So immediately, you have this problem that erupted at the collapse of Basel I, whereby, on examining the books, you have high profitability, and all of a sudden, the bank collapses. Okay. So this is an important finding that will have implications for central banks, but also for practitioners, managers of commercial banks.
2 minutes.
Yeah, 2 minutes, thanks, Dak. So let me talk about a good book should pave the way in terms of where we are going forward. This book provides very strong motivation for extending this strand of literature, the balancing act, okay, the knife edge problem. How variations in institutional framework may alleviate the evidence and insights we have on balancing inclusive growth and financial stability. And indeed, one needs to look at this in terms of, for example, fragile states, and also extending this work to look at institutional frameworks, like in the West African Francophone tied to the French system, or to the euro in this case, how these banks kind of operate, and how central banks, which don't have the independence, in quotes, can be able to do the balancing act. But another important extension of this work is to look at what I can refer here as the Trinity. So in this book, we are balancing financial stability and inclusive growth. But the agenda has to include inclusive finance. So it becomes the Trinity of financial inclusion, financial stability, and inclusive growth. Fortunately, that's what my new project is going to look at. And in the new project, it's just more or less, I have a continuity of the group of Stephen Griffith Jones, with Ricardo, with the Judith Tyson here, and another group that is made up of a consortium of University of Birmingham, University of Nottingham, Loughborough, University of Ghana, Legon, IDS, ODI, University of Groningen, Netherlands, Laval in Canada, Columbia in the US, and the African Economic Research Consortium. And for the next 4 years, we're going to be looking at delivering inclusive financial development and growth. And therefore, we look at the Trinity of our. So, in conclusion, I really strongly endorse this outstanding book. I think it will strike a chord with many African central bankers and also with practitioners. Thank you very much.
Good. So there's a strong endorsement for the book and that it's timely and influential. So I suppose there are a number of debates that we can have and lots of questions and answers that we can have. But let me just mention sort of 3 issues. I think what Stephanie and Victor have mentioned is the importance of the cost of finance, not just the availability of finance that is important, but also the cost of finance. And thinking around that, so the quality of finance matters. Second point is one about the role of the financial sector in intermediation. That is supposed to be one of the key roles of the banking system. Is it still playing that role? And could it enhance that role? And is there a role for development banks? So I think Olu was mentioning that, and Stephanie was mentioning that. What do we think about that issue? And thirdly, I think there's also been some discussion about the Basel III banking regulations, and maybe they aren't as appropriate as they should be for low-income countries. And what is then the answer to that question? But I'm sure you have other questions that you want to raise. So what I'd like to do is just take a number of questions at a time, and then go to the panel. Make sure you introduce yourself, please, and speak in the microphone, and make them short if you can. The points. There's the microphone. Over to you.